look at the global or macro environment, we see higher for longer interest rates and through gradual rate cuts by major central banks. We have been waiting for cut of interest rates. It's coming through. We have the view that maybe we'll see the first cuts in the fourth quarter, but we are encouraged. Switzerland has become the first country to start cutting the interest rates, confirming evidently, not just by the absence of 3 quarters without the Fed touching on the interest rates, that maybe the movement is here with us. The prediction is that 2024, we might end up with the Fed rate being at 4.6, assuming approximately 2 cuts, and adding up, hopefully 2026, with approximately 3% interest rates. And we have seen the period that we have gone through, how challenging it has been when the effective interest rates are high, but we have seen the inflation has started showing signs of being tamed, but stubbornly remaining high at above on average 3% across the world. When we come to Africa, in midst of all this, Africa has emerged, and specifically East Africa, has emerged as one of the fastest growing regions in the world. In the top 10 countries, we have Tanzania and Rwanda as 2 of the fastest growing countries. If we expand that to 20 countries, Uganda joins the rank, and if you extend to 50, then you get Kenya, DRC, and South Sudan joining the rank, making giving a region whose countries are all in the top 50 fastest growing countries. And again, that shows the momentum. When you look at the characteristics, then you see maybe this growth will be sustained for a long time. Why? Because it's fueled by foreign direct investments, and the region has become the second largest recipient of foreign direct investment on the African continent. When you look deeper, you see the ability of the region to integrate with the global markets, the ease of raising Eurobonds so that capital flows beyond foreign direct investment can be market made. But more importantly, we also see the resource base, whether it's agricultural land, whether it's strategic minerals, and whether it's readiness to support the centralization and deglobalization by becoming a new hub. We see a significant upside opportunity as a result in East Africa, and we feel Equity Group Holdings is uniquely positioned to tap into this growth, not just to drive this growth, but to benefit itself, to be fully transformed, and to significantly reward its stakeholders. May they be staff, may they be shareholders, may they be depositors, may they be lenders. It's not just Tanzania and Rwanda are among the top fastest growing countries, but a country like Tanzania is showing a possibility of very high ceiling in terms of opportunity for growth. The gas fields in Tanzania, the agricultural potential of Tanzania, the infrastructure development of standard gauge railway lines in Tanzania gives it the impetus that will be necessary. When you look at the entire region, 63% of the entire population of nearly 380 million is below the age of 24. So if you take that as a consumer, it's a consumer that can be a customer for the next 80 years, given modern science and modern medicine and the fact that lifespan within the region is growing. More interestingly, is the median age of the region is below 19 and ranging between 15 and 19. Again, affirming what may be demographic dividends that would come from the region. Again, DRC stands out, whether you talk about energy potential, clean energy, whether you talk about strategic green minerals to power clean energy technologies, whether you talk about hydro, whether you talk about Alabolad, DRC stands out. And of course, when you look at the financial sector, banking has done well, penetration is reasonable, but insurance penetration is still at the range of 1%, and the headroom of 99 gives us a huge opportunity as a group to grow. This is a region that has adopted technology, and if you look at the mobile penetration, and particularly if we single on Kenya, which mirror the other countries, we have 124% penetration. We have more mobile phones than the population, suggesting that adoption of modern technologies. But it's not just this region is endowed, but this region has proactively positioned itself to be an ecosystem of trade connections. This is the most integrated region on the African continent. The common trade area has really been adopted. And if you look closely, you'll see Uganda is Kenya's largest trading partner, and you can see Tanzania is not far, Rwanda is not far, and we can see the countries are trading with each other. When Kenya exports $820 million of exports to Uganda, Uganda also exports $601 million. So it is cross-border trade at another level. And this is the region that is likely to make the African free continental trade area viable and to set the example of what it is. Given then Equity Bank in that region is number 1 or number 2 in 4 of the countries, and particularly the 2 largest economies, Kenya and DRC, it demonstrates how well Equity Group Holding is at the heart of East African thriving ecosystem of trade connections. And Equity has been proactive, facilitating trade missions in between these countries to make it a common market and ensure our business people are faced by a 380 million people market other than the country population. We can zero on DRC and see the largest country in sub-Saharan Africa also presents a new and exciting frontier of continued sustainable growth for Equity Group Holdings. And this is what we're saying. Strategy has been positioning equity to be at the center and the heart of this formidable transformation that is happening before our eyes. I'm pleased to inform you that Equity is 27% of the entire banking industry in DRC. What it means is that for every 10 customers in DRC, 3 are in Equity Bank. That's broadly what it means, or the value of transaction for the banking industry. And in the midst of what we have just talked about, the endowment of DRC, then we see how well Equity is positioned to be a catalyst of transformation whether it's value addition in the mineral resources, whether it's in the agricultural transformation of the world's powerhouse, whether it's in development of energy, hydro, whether it's the headquarters of Equity being in Kenya, strategically positions us at the gateway of entering East Africa. Kenya's elevation in terms of human skills, Kenya's elevation in terms of social investment, particularly energy, education and health, a very skilled human capital, a functioning civil service, elevated infrastructure development, interconnectedness with the landlocked countries, position Equity's headquarters at the core and at the center of what things will happen. So I would call it strategic positioning. We're also very impressed with the reforms, the governance and institutional reforms taking place in Kenya and DRC particularly, and the transformation we are seeing in Uganda, Rwanda, Tanzania, Uganda. So each of the market is at a different level of transformation, and we trust that will be really give us a very unique positioning and a unique opportunity now to benefit from the transformation happening before our eyes. If we look at Equity specific as a group, Equity has now emerged as a premier regional financial service provider. It's no longer the Kenyan banking leader. We see that there is significant transformation, and we can see the impact in terms of what Equity has become. A 1.8 trillion balance sheet that tells you the largest regional banking customer base, branch network, deposit base, with very efficient operations, cost-income ratio of 52. We see organic and fast-tracking that through mergers and acquisition, and we can talk about the latest acquisition in Rwanda that has converted Equity in Rwanda to be an 18% market share financial group in that country. So when you look at 27% market share in DRC, 18% market share in Rwanda, 14% market share in Kenya, then it speaks of how significant Equity has become. Despite all these and being the largest balance sheet, we see the group continuing to grow, deposit growing at 29%, speaking to the customers' preference of Equity Bank. Deposits is a choice of the customers who to deposit with, and when your deposit grow at 29% during difficult, turbulent period, then it means the brand is not just celebrated as the strongest banking brand in Africa, second strongest brand in the world, but the customer growth in terms of deposit acts as a huge testimony. But Equity also has been prudent. It doesn't say the times are difficult, the risks are too high. As we can see, it grows lending at 26% when we are dealing with high inflation rates or very challenging macroeconomic times. Equity doesn't avoid risks, it manages the risk. And we can see it never abandons the customer, and for that reason that it has created a symbiotic relationship, a trusting relationship with the customers, and that is what guarantees equity, that even during difficult times, it can still have equity and a return of 22.3%. Significant return above market rate because of the confidence. When you look at our customer human capital and Brad, as we have said, we take pride of being the owners of the strongest banking brand on the African continent. Second strongest banking brand on earth. We take pride because that is a reflection of who we are, what people say we are, how people regard us, and how people hold us. And that is because of who we are. That speaks of our governance structures. That speaks of the quality of our human capital. That speaks of our systems and our processes. But more importantly, speaks of our governance structures that partake to this growth. And forever we'll be grateful to the shareholders for giving us 5% of the value of the bank as staff, so that as we work for the shareholders, we work for ourselves. We are aligned in interest. We give our all because we are beneficiaries of what the customers' generosity has been. So the governance and organizational structure continues to attract breadth and depth of management team, and an organization can never be better than the quality of its people, and we take pride that we are the best second brand on earth because we have some of the best human capital anywhere in the world. We have 26 nationalities in our executive management, reflecting a brand that has a universal acceptance across the board. Very strong governance structures to manage the risks and to manage accountability, to hold people to account, and to ensure a mechanism of cross-checking each other, both at the strategic level and at operational level. As a result, we have been able to build a sustainable financial ecosystem. We have been talking about it, but now we have the banking group in 6 countries and a rep office on in the 7th for its doors to open, knowing that Ethiopia is one of the top fastest growing economies in the world. We have Equity Insurance Group projecting by the end of June to have a life insurance, a general insurance, and a health insurance, completing the entire offering of health, so that we can protect lives, we can protect health, but more or equally important, to protect the wealth that we have helped to build, so that growth becomes sustainable. And of course, we all know about Equity Group Foundation, which has become increasingly bigger and that is shaping the brand of the group. And now Equity has evolved from the brick and mortar infrastructure to now be on a technology platform that has allowed us to digitize our business, to become an online business, to compress time and distance, and more importantly, to give our customers the power of control of their money. They do bank, they onboard themselves, they navigate on the platform, and they consume the products they wish to consume across the 4 groupings. This has then led to positioning ourselves to grow with the East Africa of tomorrow. We truly believe that if East Africa is the fastest growing region in the world, the East Africa of tomorrow will look very different from the East Africa of today. And we take pride that we took a proactive strategic decision to position ourselves at the heart of that entire region. And now we have strategically positioned ourselves to grow, to be the bank of the East African of tomorrow. With the largest capital base in the region, the largest customer base, the largest balance sheet, and being systemic in all the countries in the region, being in the top 4 countries except one, it shows how Equity has positioned itself to drive and to benefit from that unique position and the opportunity of rapid growth. So Equity has also equally transformed itself into a unique financial services platform with exposure to attract East African market. So it's no longer focusing on one country. It's looking and recognizing the opportunity that the East Africa of tomorrow will generate, will create, and saying we want to be in the driver's seat, we want to be a catalyst, we want to be an enabler, and we want to have the capacity and competence. And Equity's credentials have been proved by the last 7 years, since 2016, when we went through the interest capping challenge or shock, went to COVID, went to Ukraine last year war, we went all through to disruption of global supply chains. We went through the current macro, and yet Equity is emerging stronger, resilient than ever before. I want to pay tribute to our team of risk leaders who really have kept us true to our conviction that risk need to be proactively managed. Risk need to be managed through governance structures, policies and procedures, and risk management is a culture. It's not just transactional, it's a culture of decision making, of behavior, and we are very grateful that we are able to do. So the high growth potential in the markets our banking group serves, or the entire group serves, again, shows the size, whether it's the domestic credit, what is the opportunity. And if you look at the opportunity in private sector lending, it's enormous. Kenya has the highest penetration, 31%, but from that 1%, we go straight to Rwanda at 23, Tanzania 15, Uganda 13, DRC 17, and South Sudan 3, showing the headroom, the opportunity, and maybe the length of the runway or the height of the ceiling that provides us with the opportunity. When you look at banking account penetration, Kenya with 86%, followed by Uganda at 60, Rwanda 56, Tanzania. All this data confirms the East African region is a growth region for financial services. And again, when you look at our position 1 in South Sudan, position 1 or 2 in Rwanda, DRC, and Kenya, and position 5 in Uganda, and position 13 out of 54 in Tanzania. 9% return on equity, 26 in Kenya, DRC 21, high earning assets. And as then you can see, in all this story, we see loan to asset ratio is at 45%. And we believe we cannot optimize profitability at anything between 75 and 85% loan to deposit ratio, meaning DRC can double its profitability at the present size, simply by allocating cash into loan book. And that is the opportunity that we all need to see. Tanzania, another high potential market where we are low or smallest in size, but with the greatest potential. But we can see its potential that we are unlocking. Revenue growth 32%, asset 32%. So there is a direct correlation in each of the parameters. You grow asset 32%, revenue grow at 32%, and you get that level between the countries, Uganda. And when you go to Tanzania, 29, 26. So the efficiency of operations, the execution power, which this group is known for, is at play. And that is what has completed the picture. So the new frontiers for growth in the banking for equity then becomes, again, Rwanda. And we'll talk a little bit about Rwanda when we celebrate the acquisition and merger that happened in the last 6 months of last year, giving us a market share of 18% of the entire market. Rwanda, one of the 10 fastest growing economies in the world. So the picture would not be complete if we were not to look at the asset quality, distribution and mitigation, the loan book growth, which is in the next slide. It's good to look at the earning asset mix and how well it is. We have achieved almost the same mix in all the countries, whether it's Kenya, BCDC, the NIMS, the return on asset, to just give investors transparency so that you can really be able to frame. But if you look at the slowest growth is happening in Kenya, 4%, DRC 67, Uganda 25, South Sudan 56. You may be thinking South Sudan is unsafe. A loan book is growing at 56. Rwanda at 92%, giving the group at 26%. A distributed growth. There is no concentration. And truly that's why we said it's an East African risk. It's no longer a Kenyan risk. I always see us being tied to the macros in Kenya, but we should be tied to the macros of the 6 fastest growing countries in the world. And when you look at them, Kenya is not. But when you get priced, we are priced on Kenya. Yet, the DRC is where we have 27% of the market share. Rwanda is where we have 18% of the entire market share. Kenya is only 13%. We are not a Kenyan risk bank or group. We are a regional risk group. So it's very well distributed. Again, tribute to the risk team, Emmanuel leading us in credit. Our NPLs, as we promised last time, we believed it had peaked. As at September, we are 12.2. We are down to 11.7, and we believe we will sustain a downward trend, a downward improvement in the quality of the loan book. It again demonstrates our credit team, led by Emmanuel McDare, that they fully understand this risk. They promised in September, they have delivered in December. I hope you also deliver in March. Yes. Confirmed, so the decline has started, and that to me is, but it's the coverage that gives me courage, the prudence, the conservative management style in the organization, that despite showing improvement, the bank decided not to carry the risk of this NPL into the future and bring it to this year And as we saw, this is the highest provisions we have ever made in the history of Equity Bank. 32.8 billion. Not because the loan is deteriorating, but because you want to properly apply IFRS 9 provisioning, taking the entire lifetime risk in a loan during a performance year. And so we chose that we leave the challenges of the difficult times behind by ensuring we have fully provided for the loan book. And that gives us the coverage that we are seeing, very high coverage of 90% when you combine actual provision and the guarantees. Again, you can prudence again, segment distribution of the loan. It's corporate, SMEs, personal, and retail. A fair distribution. Again, geography, we see Kenya, the oldest subsidiary, only 51%, DRC 32% of the loan. So you can see the correlation between and the parity between deposit and loans, and consequently size of the risk and distribution within the region. But I don't think the picture is complete without saying it's not that we are managing the loan well, but relative to the industry. Our NPLs are at 11.7 when the industry is at 14.8, and we have the best coverage in the market. Again, that talks about the defensive approach management uses prudently provide. And of course, the potential, the hidden opportunity is in the treasury efficiency. 40% of the entire balance sheet, actually more than 40%. We're talking about 1.8 trillion balance sheet, but 500 billion is in government securities. That is the biggest opportunity, that you could be able to reallocate this to credit and increase the earnings, the yields, the margins by nearly 60%. And given that the East African region is the fastest growing, the opportunity to reallocate is not a constraint because the market is growing, the region is growing, the demand of the market is pretty high. So we have packed this. We can see how efficiently it has been done. And I want to really thank our team, treasury team, trade finance team, led by Shisha. Shisha, maybe you could wave, group treasurer, the Kenyan treasurer, Daniel Gashau, Kennedy, treasury. That team has done an amazing job to look after 40% of the entire balance sheet. And not just look at it after it and manage it well. As we said, the headwinds seems to be breaking. We can see the mark-to-market, the improvements, as that if September we were 88 billion, as at December we are at 55 billion. We are now below 49, and we have seen the yields on the Eurobonds below 10, suggesting that by end of March 2024, that number will improve. Remember that mark-to-market is passed through comprehensive income. It's netted off against our capital. So if you are computing net asset, please add another 50 billion to net asset to do actual valuation of the bank. And we look at trade finance. Kennedy seems not to be in the room. That's the team that has demonstrated that equity has gone up the value chain Our fastest growing product or tool is trade finance, again confirming the interconnectedness of East African community, the economic activities on the trade routes. Trade finance revenue grew at 90%, but trade finance related lending 106. I was amazed when we took our 300 traders to DRC. After 2 months, they had given us an opportunity to fund them $2.1 billion US of facilities. That is what is reflected here. The cross-border trade, the interconnectedness, we talked of the trade connection between the countries. It's a huge opportunity. And you can see trade finance guarantee and off-balance sheet items, again, making it easier for our traders. And of course, when you look at profit, the interest margin edging up as we move money from government stock to lending, the yields edging up, cost of funds, again, looks like we said has peaked and has started to show early signs of decline from 3.9 to 3.8. And when you look at the yields on loans, relative to the market, we seem to be doing pretty well, 12.7, enhancing when the industry is coming down. It was slow, and I may say this, because the top line in equity, we'll see that interest income is growing much slower than interest expense. We couldn't shield ourselves from interest expense, but there is a segment of Kenyans we said we will not pass the interest expense. Beginning of last year, our risk-based lending was approved. We could have adjusted consumer lending, salaried and payroll salaries, but we chose not to subject Kenyan workers to the headwinds. The payroll lending, consumer lending, if you call it, constitutes 32% of our entire loan book. Anybody who had borrowed as at January last year, they are still paying at 13%. When if you borrow today, you pay 24%. That is the generous heart of Equity Bank. When we talk about caring financial partner, Equity practices what it says. And so when you hold 32% of the entire loan book at 13, when you hold 50%, 500 billion, 40% of the balance sheet at 11%, it means 70% of earning assets are earning below 13%. Weighted average between treasury bonds and consumer loans is 11%. But we are funding that loan book at deposit at 18%. And that explains to you why you'll see cost of funds, we are above the market at 18%. Yields, we are below because of subsidizing consumers. But we take pride that the civil servants, the teachers, the salaried people are able to take care of their families because Equity has stood with them during these high inflationary times and when the Kenya shilling has shown signs of weakening against the dollar. It's something we take pride of. It's what the foundation then takes to the next level, and we all know what Equity Group is doing. As we earlier said, Equity is not just banking like it used to be in Kenya. It's now a financial group. Insurance is promising to be as big as the bank, and we see the opportunity in insurance. In East Africa, penetration is only 1.34. This is where banking was in the 80s. And as we saw, we disrupted that, and now 86% of all Kenyans are included or have bank accounts. This is the opportunity Equity is chasing, to see to it that inclusion reaches 50% in the next 5 years. So when we talk confidently that the insurance group will rival the banking group, it's because of this opportunity. Low average insurance penetration, and consumers in Africa are in financial distress, we all know. We insure ourselves through social group, families, plots, and such things. We think like we disrupted banking, we shall disrupt insurance. And we disrupt insurance as we think by making insurance accessible, relevant and suitable, affordable, and bringing trust that insurance is reliable and dependable than we think. And that explains why we have taken a very challenging tagline for our insurance group: the insurance you can trust, because we want to be challenged on trust. And it's only by breaking the barrier of trust that we believe insurance will take off in this region. So we are taking a three-pronged approach to insurance: protecting life, protecting health, and protecting wealth. We work very hard. We all service our cars every 3 months. We want everybody to service themselves through a health wellness program covered by insurance. But when an incident comes, then we don't pay out of pocket, but insurance pays. By collectively bearing the burden, we can make the burden very light for each of us, bringing affordability to insurance, distribute insurance adequately, the supply side. And I'm glad to say we now have almost 120 Equity Afya hospitals. This month will be a record month. We'll be able to see over 100,000 patients in 1 month, suggesting that the product and rating has placed us number one in health provider when you combine accessibility, affordability, and quality. And if on quality standalone, we are ranked number 2 or 3, number 3 in the country. So that is the offering we're making, and I'm glad that the MD of Equity Afya, maybe a wave, is here with his team of doctors. So that is, so the opportunity for health is much bigger. So the Equity Insurance Group, as we can see on the next slide, the opportunity is big in whichever country you take. And that data, so we have analyzed the data to map the opportunity, to be able to craft it. And I'm glad that we have our MD for the insurance group in Nigeria. We have the MD of General Insurance in the room, the MD of the Life Insurance, and the Health Insurance. So we are not talking of what we shall do, it's what we have done, and that is why we are able to provide this. From the onset, insurance has done better than we did in banking. In terms of market positioning, it's a very, very good start. We have only been in operation for a very short period. We have been in operation for 21 months as at December, so it's less than 2 years. The first year was 9 months. Last year was our first full year, but as you can see, as at September, we had managed to take position 4 in profitability in group life, 7% of the entire market share of group life and credit, and we had managed to get 2% of life industry market share and take position 11 in the ranking of insurance, and position 5 in terms of group life. So very confident that this is an area we'll do very well. If people have been judging my enthusiasm about insurance, my pronouncement about insurance, data supports my confidence that will transform insurance like we shall transform health, because health will be part of this. So the growth and expansion story of insurance, as we can see, it's very well covered. We know the potential with the distribution capabilities we have, the alignment we have been able to make to our anchor strategy, the African Recovery and Resilience Plan. We know where the market is, we know the headroom, we know the length of the runway, we know the tools to use, and we are glad that we have entered insurance and it is profitable. And if you look at the product offering, again, we are addressing the needs of the customers. And we can see the first few months, the number of customers, we reached unique customers, and where we are, what is to be insured, what product, and how the cost structure, how the non-funded income will be affected. And I will invite you to look at these details, because as they say, the devil is in details. So you understand the preparation. So if we move to the next slide, and we see performance and growth and demonstrated distribution capability. Look at what has just happened. Insurance revenue last year grew by 57%. Total revenue grew by 68%. Profit before tax grew by 39%. This is a startup. You're talking of a startup. And if you look at the total assets of the startup, is 20 billion shillings balance sheet. And the issue we could see is last year's but one numbers, 4.9 billion gave us position 11. 20 billion will put us in the top 5 largest insurance. Look at return of a startup. Last year, return on equity 60%. Despite the growth, return moves to 70%. A return on asset of 5.4, much higher than the return that we have in the bank and the group, and we have been able to manage the loss ratio. But look at the startup's contribution to equity profit before tax, 1.8%, almost 2% of the entire profit of the group before tax is now coming from insurance. Revenue, 1.4, total asset, 1.1. But look at total asset, 1.1, but profit before tax, 1.8. The amplifier, because of the efficiency, because of leveraging on the capabilities. But what is most encouraging is the uptake of policies. So if you look at the performance and growth and distribution capability, we have been able to issue 9.94 million policies in 21 months. So if you divide that by 21 months, it gives you the intensity of distribution of policies per month. And we can see new policies last year were 5.5 million policies. The unique customers reached in just 21 months, 1.3 million customers. And we can see digital distribution, 82%. People might have been asking themselves, why would a startup have a return of equity of 70%? It's simply because the insurance is not using brokers and agents who take maybe close to 40% of the revenue. It is using technology capabilities, and it's also leveraging on bank assurance. And we are grateful to the MD of Kenya, Gerald, maybe you could wave, for giving us an opportunity to partner with the bank assurance and be able to demonstrate. Now, extrapolate this growth, George, and tell me where insurance will be by 2030. And give me just one reason, George, as a friend, why insurance will not be bigger than the bank. Ajara, you will have failed. If you not become, insurance will not be bigger than the bank. And I know failure is not part of your vocabulary. So we're very, very confident. As we said, we have the right people. You can have the right strategy. If you don't have the right people, Ajara is really supported by a very able team. The MDs of the insurance company, the leadership of the insurance group. Maybe we could start. As you can see them, they are very seasoned persons. Very seasoned persons. The best MDs we could get in the market. As you can see, they are all MDs from the best insurance in the market. And that is why a good, thank you very much, colleagues. I'm very proud of it. And that is the power of a strong brand. A startup attracts the MD of the, or the MDs, not one, not two, not three, of the largest insurance companies in the country. The reputation. People seem never to understand when you talk about brand value. And I'm really excited that the brand value of equity is nearly 70 billion shillings on a standalone basis. That is how you monetize brand. You say you want leaders to start your business, and you attract the best people globally. I guess you are South African, Botswana, Zimbabwe, Zambia. Now you can see Kenyan. Now you can see we are spoiled of talent. Now you can see how easy it will be if Equity chooses to go to Southern Africa. They have already understood the culture, they like the brand, and they have chosen to come for the brand and take it home. So that is the power of brand, and we are glad that we saw it in advance to protect the Equity brand, and we are able to monetize it. That is now the second group. The third group that I'm very grateful about is the technology group. And the technology group has managed to help us move from our brick and mortar infrastructure to a technology platform. And this group provides coordinated, agile, and extensive technology capabilities. And so it provides across, it is mapped against the African Recovery and Resilience Plan. And I want to recognize our IT gurus led by Michael Coffey. Michael Coffey and your team can stand. I can't thank you enough for liberating us. Very good. Again, very seasoned people from Tanzania, from Nigeria, Kenya, Ghana. Again, Africa is in the room. If you didn't really understand equity, that's the power of a brand. So we solve the problem with the best talent you can get anywhere in the world. Thank you, colleagues. So let's look at what the technology group has done in just a very short time. By moving us from branches, look at what that team did. It allowed us last year to give 6.2 million loans worth 284.6 billion. Loud it to 285 billion. You can never do that in a branch. You can't be able to have 6.2 million people walk through a door and do manual papers. And we can see, so, and when you look at the repayment of the loans, as we can see, it is very high. One slide back, please. If you look at the revenues, growing at the same level with repayments, with the growth in disbursement. So essentially, very efficient capability, very efficient system with minimal capability. Alvin, you didn't start with the technology team. You host them in FinServ. So Alvin provides them with the infrastructure and they bring the capability. So the group enablement, as we can see, it's group-wide when we look at the next slide. And so these loans are distributed throughout the entire region. So it's a one-instance system that provides loans across the entire region. And we can see the impact that it has, the growth rates we are able to achieve in each country, whether it's a disbursement and whether it's on value. And then we can see the freedom of choice we have given to the customers to choose the channel and to choose the device. So the technology group enables banking business. And we have migrated to fixed and variable channels. So there is still a group of customers who are going to the branches, but as you can see, it's a declining. Last year, the number of customers going to or transaction done in the branches remained the same like the previous year. The number going to the ATMs declined by 10%. But if you look at the value, ATMs grew by 17% and branches by 14%, meaning branches are now for the high net worth transactions. They are SMEs, corporate businesses. The individual transaction, personal transactions have moved, and either they have moved to the variable channels, agents and merchants. But again, we can see the customers are moving from merchants, they're moving away from agents. And where are they going? They are going on the self-service channels. And whether it's EasyNet, Pay with Equity, merchants, whether it's EasyBiz, whether it's EasyFX, whether it's Equity Mobile, whether it's Equitel, that's where the customers are. That's the banking of the future. That technology stack of capabilities has transformed this group. And now this group has first mover advantage. The COVID acted as a tailwind for adoption. We struggled a little bit the last previous 2 years because the volume of transaction grew faster than our capability. But I want again to praise and to acknowledge the technology group for what they have done. They've been able to migrate under the leadership of Sam Kerobe, our technology, renew, move us from legacy systems, and we now are confident that we have the best breed of technology system, whether it's for processing, whether it's for storage, whether it's the transaction processing, whether it's the application, but more importantly, the customers have the freedom of choice. Equity Group is no longer the place you go to. It's what you do on devices, wherever you are, whatever time. We have compressed distance and we have compressed time. We are now an online banking business based on our technology. So when you talk about technology companies in financial services, start with equity. because we are now using digital capabilities. It will take time to carry people along, but we have seen the transactions, we have seen the channels and the movement. Branches are now for customer acquisition. Branches are advisory centers. Branches are centers of excellence. Branches are centers for selling, not for transacting. We transact online. We have become a digital business, as we can see in the next two slides. And we see how the channels are moving. You have moved too fast. The merchants, the ATM, the branches. At the bottom, it's agency, which are flattened out. It's the digital channels. Look at the number of digital channel transactions in millions. 805 on digital devices. Branches, 18 million. Merchants, 19 million. So, self-service capability. Equity Group is a technology platform providing financial services. And the data then becomes even more greater clarity when you look at 98% of all transactions outside the branch. They're in the digital channels in terms of number. So broadly, this speaks a lot about the capabilities that have been built, and the build-up is complete. We now have a capability, and when you look at number, cashless transactions, 2022, 82%, and this year, last year, 85. So if they are cashless, then we are a digital organization. We have digitized banking. We have digitized insurance. And access is in that perspective. And very few go over the counter. The rest, 9%, is third party. 7% is in the branch in terms of value. So, and that then gives us an opportunity to go to the fourth group. We have done banking, we have done insurance, we have done the technology. Our fourth group, we are no longer in core banking. We are a very diversified investment group in banking, in insurance, in technology, and in philanthropy. And with that, let me introduce you to Impact, Investment, and Sustainability, the Equity Group Foundation, which, as we saw, is in education and leadership, Wings to Fly, ELIMU, and ERP, leadership development under ERP, enterprise development, financial inclusion, entrepreneurship, health, energy and environment, food and agriculture. I can broadly say in food and agriculture, you all know, we're in partnership with the government on Kilimo Biashara since 2008. It's our flagship agricultural produce. The intervention of the foundation to capacitate small-scale farmers to move from peasantry farming to agribusinesses has increased our lending to agriculture from 3% to 16% of our entire loan book. And I take pride as a Kenyan that I respect and recognize where I was brought up in rural villages. If we don't fund agriculture, which is contributing 30% of our GDP, something is wrong. So we have chosen to lead the way, and we promise by 2030, 30% of our entire loan book will be in agriculture, so that we give rural communities an opportunity to be funded. We are a bank that is listening, caring financial partners. Agriculture has failed to transform because of lack of credit. We thank the foundation for being the catalyst by capacitating the farmers, de-risking them so that we can. We are the sole partners of World Food Program, IFAD, and World and FAO in the entire region because of our commitment to transform this region. Energy and environment, as you all know, we are taking pride, we are in celebration mood, and we want to invite you to celebrate with us. IFC, the private sector arm of the World Bank, named us last year as the bank that has the highest number of climate financing loans for mitigation and adaptation worldwide, not in Kenya, not in East Africa, not in Africa, but worldwide. And we take pride that we have chosen to provide leadership. The adaptation of sustainability talks about our mindset about risk. Risk is not just within the internal environment, risk is also about the external environment. If climate has threatened our communities, we have chosen to address that by providing our communities with risk mitigation tools. That's why we have the highest number of loans anywhere in the world dedicated to mitigation and adaptation. We also take pride that we have been able to empower 450,000 households to transition from fossil wood fuel energy for cooking into renewable energy. And that is something, if nothing else, we are proud of, is that we are addressing health issues with families that are exposed to dust or smoke dust in crowded kitchens. And we have extended that now to schools, and we are on our way to converting 8,000 schools that operate kitchens to move away from using wood to using LPG, again, to liberate our kitchen staff in all our schools, to protect our school children from harmful smoke and emissions as our contribution to lead a responsible citizen, but more importantly, because it's the right thing to do. So quite a lot of investment. Health, as I said, this month will be a record month when we see more than 100,000 patients walking through the doors of 120 Equity Afya clinics, providing health.